All right, welcome everybody to another edition of River Rock Financial Group's series of presentations about how life insurance can benefit you. In this particular presentation, what we're talking about is mortgage protection with living benefits. Now, mortgage protection insurance is different than mortgage insurance, which I'll talk about here in a second. To clarify what some people may think is what you get when you close on a house at closing at a real estate attorney's office. So mortgage protection insurance is different than mortgage insurance, all right, or mortgage insurance. So when you hear the term mortgage insurance or PMI, that's not mortgage protection insurance. So, but without further ado, let's go ahead and get started. If my okay, all right. So River Rock Financial Group is the agency. We are licensed in Georgia, North Carolina, and Texas. My name is Max Wiltz. The presentation we're going to do today is mortgage protection with living benefits. You can find us at Instagram, Facebook, and YouTube at River Rock Financial Group LLC. The website is rrfgwealth.com. So, what is mortgage protection and living benefits? First, let's talk about our mission. Our mission at River Rock Financial Group is very simple. We're here to educate families, businesses, and individuals about three things: how to accomplish these three things using the power of insurance. One, creating and sustaining generational wealth. Two, strategic future financial planning. And three, asset protection and accumulation. A lot of people think insurance is for just dying. It's not for just dying. Insurance is for living. So, without going a little bit further, or before I go further, I should say, these three things are the foundational mission of River Rock Financial Group. Okay. So, with that being said, let me go ahead and continue. So, for centuries, people have accumulated and passed down wealth to their families using insurance. Once again, we're talking about mortgage protection insurance and living benefits, not mortgage insurance or PMI. Okay. Historically, it's been used to increase wealth, pass down wealth, fund retirements, and avoid certain tax situations. Now, you may be saying to yourself, and before I go any further, uh, understand that I am not a tax attorney. I am not a tax preparer. So please consult your tax person, your tax specialist. Before, let me go back a few. All right. So let me cover myself. All examples are for illustrative purposes only. They're not representative of any particular investment or an offer of insurance coverage or benefits. Values shown are before tax. All withdrawals from a retirement plan are taxable as ordinary income. Please consult your tax expert or advisor. All right. Sorry about that. So, time and consistency are the keys. Time and consistency. A lot of times we look at people that have amassed or are the beneficiaries of someone amassing wealth, accumulating assets, and we think it's right now. Herein lies the problem. Problem is not that rich people are taking from you. The problem is that people don't understand that in order to get to a certain level, you have to allow time and asset accumulation to compound. Right? So this has been going on for centuries. If you do a little homework, you'll see where a lot of individuals and institutions have used time to create this massive amount of assets that they then use to grow their other assets. All right. All right. So we insure everything. Cars, which by the way is a mandatory tax. but then cars have other insurances, right? They have like long term maintenance insurance deals, boats, motorcycles, pictures, recreational vehicles, jewelry, electronic devices, arms, legs, athletes. But many times we do not insure the thing that's most important. We don't want to insure that. But we would rather do what a lot of people do, and I'm guilty. What a lot of people would rather do is wait until we get close to crunch time and then we try to rush and get insurance. Then we buy things we consume. So not only do we insure everything else, phones, laptops, all types of stuff, right? But then what we do is we consume and we don't understand the relationship between your consumption and the things that you're insuring except for yourself. We go close on a house and we get PMI, or the lender gives PMI, or however you close on the house, whether it's a 15-year, 30-year mortgage or whatever, and they give you insurance, but then you don't turn around and insure yourself, and you don't make sure that if something happens, that's covered for you and your family. Now, the mortgage company, the banks, they've been playing this game a long time, so they're already insured. They insure before you even get around to talking to them. As a matter of fact, they're insured against all types of stuff. They make money whether you win. They make money whether you lose. They make money if your house goes into foreclosure. They make money if you sell the house. They make money when you refi the house. They have insurance on everything, but the majority of individuals do not have insurance on their houses in relation to life insurance. We buy overpriced and we consume overpriced consumer goods, designer clothing, coffee, hyped up products, whatever it might be. I'm guilty too. We go out to eat daily, weekly at restaurants, fast food, concerts, phones, gadgets, shoes, handbags, cruises. I'm not saying don't do any of this stuff, but if you look back and you calculate all of the different things you're spending money on, and then you look at if you could use some of that money to create an asset for you and your family, I'm pretty sure you can find some money somewhere. I don't really like to use the term money, but I'm pretty sure you can find some resources to ensure your long term benefit, B, your long term beneficiaries' uh, success. And then we pay taxes on all the stuff that we consume. The beauty of insurance is you can avoid certain taxes while you're living, and then your beneficiaries taxes are not levied. There is no tax on death benefits. Right. Life insurance has traditionally been one of the key methods for enhancing prosperity and financial security across generations. I am noticing a trend in younger individuals not really understanding the power of insurance. Some of their parents may have some small policies, but they are not willing to sacrifice just a little bit now for long-term gain, long-term prosperity. 56% of Black Americans have life insurance, according to a study done by LIMRA and Life Happens, compared to 52% of all Americans. That means that over half the population is either zero insurance or underinsured. And of that 56% of African Americans or Black Americans, most of those individuals have very small policies. And those are just life insurance policies. 46% remain underinsured, with their benefits not enough to replace income, offer cash value options during life, or provide wealth transfer across generations. I'm willing to bet that over half the population, probably more than 52%, don't have any benefits for one reason or another. Now, some of those reasons may be valid, and some of them may be invalid. All right, so why do most people not have insurance? They think it's too expensive. If you talk to me, what people say to me is, when you're talking to me, I think about death, employer policies, health. Good, my health is great. I don't need insurance. Oh, my health is too bad. I can't get anything. Lack of knowledge, lack of trust in family, carriers, and agents. So these are some of the most prevalent or most common reasons or excuses about why people don't have insurance. And today we're talking about mortgage protection insurance in specifics and with living benefits. The too expensive argument. It's too expensive not to have. At least have a term policies. Term policies are usually low cost, high face values, and a little bit more lenient with some carriers when you're talking about underwriting or getting approved. Many carriers have flexible plans. The benefits outweigh the cost. Trust me, annuities are a cost-effective way and they're low risk. And every situation is different. Most insurance carriers will look at each individual's, a matter of fact, they do look at each individual's situation. Thoughts of death. We cannot avoid death. Everybody on this planet will will go this direction. Think about family and legacy instead of death. So when you don't think about it, you're being selfish. Life insurance is about life. It's meant to move life forward, not backwards. The truth is, life insurance takes care of families when the time comes. Life insurance is a great hedge against the oncoming situations of life. Being prepared is better than not being prepared, and do what's difficult while it's easy. Do the difficult thing now. Don't put the burden on your family of having to do fish fries, GoFundMe pages, begging from other people, draining bank accounts, taking out loans. The list goes on and on about what happens when people pass away and the family's not prepared. I have a policy with my employer. Policies with employers are not portable unless you're willing to take on the financial burden and the expensive cost that comes with a life insurance policy that your employer holds. Well, a life insurance policy that your employer is giving you while you work for them. They don't have auxiliary features. They don't have living benefits. They don't have accelerated benefits. They don't have return of premium, on and on and on. And in particular, what we're talking about today is mortgage protection insurance. Your employer does not offer you mortgage protection insurance. You cannot control your values with your employers. Employers a lot of times will give you a life insurance policy and then say, okay, how much coverage do you want? And if you make $80,000 a year, a lot of times the maximum you can get is 160. You can double your income. And then when you leave or quit or whatever or get terminated, that doesn't go with you. You control your own private insurance policy. There are also situations where you can, let's say you do have mortgage protection insurance, you can actually make it where if you do lose your job for a certain period of time, you can then make it where you can skip some payments. So see how there's a difference in your policy versus your employer policy. Of course, good health means lower premiums. Challenged health is not a barrier. A lot of carriers know in today's world, there are a ton of carriers that do a lot of different things across a lot of different health categories for providing benefits. Again, annuities are a great way to have life insurance protection with no medical exam. A lot of insurance carriers today will have high face values with no medical exam. Now, once you get to a certain point, you will have to do a medical exam, probably like $1 million or 500,000. It just depends on the carrier. But a lot of times you can bypass an actual medical exam, answer a couple of questions, give your doctor's information. They can do the research and then let you know what you qualify for. So it's really no excuse. And carriers understand, I just said this, carriers understand there's a wide range of health related issues and they have adapted to today's consumer. If you want to consume something, I know the consumption of this product is not like eating or drinking your favorite coffee or eating your favorite at your favorite restaurant. I understand the difference because you can't taste it, touch it, see it, or feel it, or smell it. It's something that is emotionally charged but psychologically disconnected. And then lack of knowledge. You have to ask questions. When somebody is attempting to educate you on the benefits of insurance and you don't know something, ask questions. If you get a policy and you don't know something, ask questions. We are bound by law to answer your questions. We cannot not answer your questions. Life insurance is a straightforward policy process. I want a policy. This is the type of policy I want. I'm going to fill out an application, answer some questions, underwriting, and then they let you know yay or nay, and how much it benefits you can receive. All right, here's one of the most important ones: lack of trust in family carriers and agents. First and foremost is family. Selflessness, selflessness equals success. Your job is not to say to yourself or other people, well, I'm not going to let my family members get rich off me. I'm not going to let my kids get rich off me. I've heard it all. The bottom line is you cannot control what people do when you're gone. So the best thing you can do is plan, let people know, let your family know what the plan is. Here are the documents. This is what I need you to do. And then here are all the people you need to talk to, phone numbers, addresses, emails, contact information for all the people. And then when the time comes, you execute this plan. Not, well, I just ain't gonna do nothing because I don't want nobody to get rich off me. It's a bad attitude to have. Life insurance agents, brokers, and carriers want to achieve high standards. The typo there, my bad. This is a service designed to benefit those who understand the power of accumulation, and this is a highly regulated industry. We're not just out here. If somebody's out there doing something that they shouldn't be doing, a carrier, an agent, or a broker, best believe it will be taken care of. All right, so to the nitty gritty, what is mortgage protection insurance? It is designed to pay off your mortgage in the event of your death. Period. Now, is that all it does? No, but that's the design. With living benefits, the policy owner can access part of the face value while they're still alive. And there are other things you can add as well. But when you have a mortgage protection insurance combined with living benefits, the owner of the policy benefits now and then. The safety net for your loved ones, for your children, your spouse, is guaranteed. If something happens to you, accident, God forbid, untimely death, or or the inevitable is about to happen, then you're taken care of. Mortgage insurance, PMI, protects the mortgage company. Now, if you notice, you have insurance on a house for if something happens to the house, like if you get a water leak, or I don't even know if foundation cracks. But anyway, so if something happens in the house, hailstorm, whatever, act of God, nature, the roof is tore off, windows broken out, you can file a claim and get to pay for those things, right? And you're paying for that inside your mortgage payment. Uh, that's not mortgage protection insurance. Mortgage protection insurance is if something happens to you, then the house will get paid off, okay? Or at the very least, your beneficiaries can pay some payments until they decide what to do with the house. Once again, mortgage protection insurance, residential insurance does not protect you in the event of if something happens. Okay, and a lot of people say, "Well, I don't need that." Well, here's the thing: you don't know if you do or not, and it's transferable. Okay, there are two main types of mortgage protection insurances. One is decreasing term, uh, where the amount you owe decreases over time, and the mortgage face value or the benefit decreases over time. So there is decreasing term insurance. So, for example, you buy a $500,000 house, you've been paying on for 10 years, the benefit decreases over time. The mortgage, the MPI, the mortgage protection insurance decreases over time. And then you have level term insurance. Basically, you have a $500,000 house, you get a $500,000 policy. You pay down the house, the policy benefit stays the same. If something happens to you and you paid off, you've been living in the house for 15 years, you still have $500,000 in coverage. Okay. All right. Today's feature product is what's called the Path Protector Plus. Is a guaranteed term product. Okay. Guaranteed. So it's guaranteed and designed for people that say, hey, if something happens to me, I want my family to stay in this house, regardless of if something happens to me or not. Well, if something happens to me. All right. Path Protector Plus. So it's a 15 or 30-year term, guaranteed level benefit, and you can renew it. All right. But usually, of course, you get a 30-year mortgage, you get it for 30-year, you get it for a 30-year term, and you just let it run. All right. There's not too much more to it. You can choose between the 15. Now, some people try to pay their house off for 15 years. That's cool. And that's a different mortgage payment, right? But your term level still stays. I mean, your benefit still stays the same. So if it's a 15-year term policy at $500,000, you still have $500,000 in coverage. If it's a 30-year term at $500,000, you still have $500,000 in coverage plus the living benefit. All right. So what are living benefits? You can access part of that face value. So let's say you have a $500,000 policy and you get a terminal illness. Okay. Unfortunately, you get a terminal diagnosis. You can then say, I want to access part of the $500,000 face value. Okay. Now it does reduce the death benefit. All right. The conversion option is to convert the term policy into a whole life policy. Now that's a different discussion, but that's only when you get the policy we can talk about how to convert it. All right. However, the beauty of it is the person that owns a policy does not have to do any medical exam. They don't have to prove that they're insurable. All they have to do is have the policy first at year 20 and say, hey, I want to convert this to or part of it to a whole life policy. All right, here we go. Unlike mortgage credit insurance, where the face amount decreases as your mortgage decreases, just talked about that. The face amount, the 500,000 we keep talking about, or 300,000, or 400,000, stays the same. Okay, mortgage credit insurance. It's almost like as you pay down your mortgage, your insurance benefit decreases. Your mortgage protection insurance decreases. It depends on your goals, but would you like to have 500,000, 400,000 that's set and you pay down the house? And if something happens to you, then whatever's left over from paying off the house, you still get, your beneficiaries get the total amount. I think it's a better deal. I think the Pad Protector Plus or in products like it are a better deal because you're able to have one set benefit regardless of what happens. And it's almost like a bonus as you pay down your house. So here's an example. I'm not going to read this verbatim, but Adam and Jenny just bought a $300,000 house. This is just an example. All right. So this is, it's just an example scenario. They want to make sure if something happens, the other person, the other spouse is able to still live in the house and make mortgage payments or make mortgage payments. Okay. So there's a lot here on the screen. Adam and Jenny get a $300,000 term policy, home mortgage protection policy on each other, and they name each other the beneficiary. So in this scenario, it's a combined premium for 30-year policies, $61.70. Now, of course, Adam and Jenny are under 30. So I'm going to show you an example here in a second, or illustration. But in this particular scenario, Adam and Jenny have $600,000 in combined face value with the assurance that if something happened to one of them, then the house will be paid off. And they can stay in the house. Now, let's say something happened to one of them and they won't stay in the house. They get the insurance proceeds. They want to sell the house. Well, you can do that too. All right. It is not credit insurance. I'm trying to reiterate that. It is not credit insurance. It does, this particular product, I have to say this. This particular product varies by state. This is only for illustrative purposes. And all insurance products are subject to underwriting, even if you don't do a actual physical or somebody come do a physical exam in person, okay? Here is a example, a illustration of a 41-year-old male, non-tobacco, with an amount of $425,000 for $103.14 a month. Excuse me. And they have an accelerated death benefit rider of 10%, $42,500, which means if something were to happen to this individual, their beneficiary will receive the $425,000 plus an accident plus $42,500. So in essence, that person would their beneficiary will receive, or beneficiaries plural, will receive $467,500 for $103.14 a month. I think is a great deal. It also has a terminal accelerated death benefit rider. That's that living benefit if, God forbid, the owner of this policy receives a terminal diagnosis, they can then access part of the $425,000 face value. Let's just say they're able to access half. They still will have the other half left as the death benefit. I don't understand. It's a great deal. Great deal. Here is a 41-year-old female, same scenario, same amounts, same benefits, same everything, for $84.81 a month. Any questions, please feel free to email me at River Rock Financial Group LLC at gmail.com. You go on the website at rrfgwealth.com. You can schedule a meeting with me. Just hit the QR code. If this was live, you'd be completing blue sheets, and then you would I would be able to answer any questions you had on site. Okay. If there are no questions, here's the information again. And once again, hopefully this added some value to somebody's day. I know money is boring until you need it. So again, until next time, do what's easy Do what's difficult while it's easy.